Imagine logging into a website where strangers ask you for loans. Would you trust them with your money? Well, peer-to-peer lending has made this scenario a reality and it's exploding in popularity. Today, billions of dollars are changing hands directly between people online, and it makes us question, how do everyday lenders decide which strangers to trust? Well, my name is Shaksoda Kojakanova, and together with my faculty mentor, Dr. Gonzalez, I'll be guiding you through this presentation. Now, let's first start with defining peer-to-peer lending. Well, peer-to-peer lending is a direct financing model that connects borrowers and investors without traditional banks. Think of it as an online marketplace where people post loan requests and individual investors choose to fund them. This concept started in the UK in 2005 with one of the first platforms, Zopa, and quickly spread to the US. Today, it's a major alternative to traditional banking. There are a few characteristics of peer-to-peer loans. First, they are unsecured, meaning there's no house or car backing them, so trust is crucial. Two, multiple investors typically fund a single loan, spreading out the risk. And three, loan amounts are usually under $10,000 and repaid within 5 years. Borrowers use peer-to-peer loans for small businesses, debt consolidation, or personal expenses like home and car repairs. For investors, peer-to-peer lending offers high return potential, around 10% on average, but with varying risks. Lower risk loans have about a 2% default rate and yield 6% returns, while riskier loans can default up to 14% of the time and yield 15% returns. Now, how does peer-to-peer lending work? First, there's a sign up and verification. Borrowers and lenders start by registering on a peer-to-peer platform. Borrowers provide basic verification documents and their credit history is checked. Unlike banks, this process is more simpler and easier and honestly it's fully online as well. And two, once approved, borrowers post their loan request detailing the amount, purpose, and sometimes a personal story. Listings stay up for a set period of 2 weeks, allowing multiple investors to contribute to the same loan. With no guaranteed payment, though, investors must trust borrowers to pay them back. Loans that default are transferred by the peer-to-peer platform to debt collection agencies. They rely on available data and personal impressions, making social factors like gender, language, and testimonials highly influential. At its core, peer-to-peer lending is built on trust between strangers, with platforms managing transactions but not insuring against losses. Understanding this process really helps us see why borrower presentation matters in securing loans. And furthermore, peer-to-peer lending has been growing at a remarkable pace. There are a few big reasons why it's attracting so much attention. In just over a decade, more than 40 peer-to-peer lending platforms have launched around the world. Some banks are exploring partnerships with peer-to-peer platforms, and regulators are paying attention to this new lending era. When an industry really does grow this fast, it's hard to ignore. Furthermore, peer-to-peer lending also offers something unique to investors, giving them a chance to invest in individual people, small businesses directly. This is appealing for two main types of investors. First, pure for-profit investors that are drawn by higher return potential. They see an opportunity to earn better interest rates than a savings account or many traditional investments. And two, partially pro-social investors who are motivated by not only by profit but also by the desire to do good. For them, peer-to-peer lending is a way to have a social impact while still earning some return. And so peer-to-peer lending here is a blend of high returns and social impact is a key reason it's gaining this interest. Another reason this field is so fascinating is that it allows us to observe real human financial behavior in a new setting. Essentially, what can we learn about decision making and trust from this model? Well, peer-to-peer lending isn't just about finance, it's also about human behavior. Unlike banks, these platforms reveal biases, trust, and decision-making patterns. However, peer-to-peer lending carries risks. There's no government insurance, there's borrower defaults and platform failures. With limited information, investors rely on gut feelings and social cues. Simply imagining helping borrowers can influence lending decisions, sometimes leading to overconfidence. Pro-social investors lend more, but often underestimate the risks, while profit-driven investors are more cautious. Ultimately, peer-to-peer lending is shaped by psychology and trust. Our research explores these factors through this controlled an experiment. So let's take a look at a sample scenario. Now, let's go over how we set up this controlled experiment using a mock peer-to-peer lending platform designed to mimic real-world lending decisions. First, we had 221 finance students serve as lenders, each making 3 lending decisions for a total of 663 individual lending choices. Then we chose finance students because they tend to have higher financial literacy, making any biases or behavioral patterns they display especially meaningful. And next, we introduced a pro-social mindset. Before making any lending decision, participants were exposed to pro-social testimonial to encourage a helping mindset rather than a purely profit-driven one. And then, oh, sorry. And then furthermore, then the specifically pertaining to the experiment design, each participant saw 3 loan applications, identical in every way except for one, the borrower's photo, one featured a female, one featured a where is it? My mouse. Okay, one featured a female and a male and one neutral icon. And the trust signal there and second, it was the trust signal where one loan with a male or female headshot had already been 50% funded in 3 days, or with indicating high trust, while another gendered application took 11 days, indicating low trust to funds. And the third one with the neutral icon, was funded 50% in 7 days. We randomized which gender was paired with high or low trust to ensure unbiased results. This setup allowed us to isolate the effects of borrower gender and perceived trustworthiness on lending behavior. By controlling these factors, we were able to create a realistic but structured lending environment, helping us analyze how trust, gender, and financial framing shape investor behavior. And what we found was really interesting. First, to summarize it, lending decisions did not change when using community language. And number two, however, we did see that there is a language effect, an increase in trust, but only when the applications reported to be popular among other lenders are female. Since there's no effect in lending decisions, but popular female applicants are trusted more within the community language, there is a less confidence about making an unbiased lending decisions or specifically not lending more. In summary, peer-to-peer lending platforms do not need community language options for educated users who are comfortable in English. In addition, this decreases the community bias that gets reinforced by herding biases. And there is a trust effect for female applicants who are popular among other lenders, but it does not result in biased higher lending decisions. Our recommendation is that platforms should keep loan applications in English for educated users. Thank you.